Good evening, everyone. Thank you for joining us. My name is Geraldine. I am a consultant at Ecosustainability. I shall take about an hour of your time to talk about the fundamentals of carbon accounting. In this session, I hope you will learn what carbon accounting really means, why it is critical for sustainability reporting, ISSB readiness, and decarbonization strategy, as well as how organizations measure, manage, and reduce their carbon emissions effectively. If you have any questions, we would be happy to answer them at the end of the talk. So, Ecosustainability is a consulting firm headquartered in Singapore. We have 21 consultants, and we are present in 5 other countries, namely Malaysia, the Philippines, Indonesia, Thailand, and Cambodia. Our main service is reporting. As most of you know, sustainability reporting has become mandatory in many countries in the region. We also do consulting to help companies decarbonize. We manage carbon credit projects and are currently developing 3 carbon credit projects in Indonesia. We do trainings as well and partner with universities and learning institutes to deliver courses to professionals, SMEs, and large corporations. We also have a think tank arm called the Climate Policy Lab, where we do active standard contribution work at the global level. We work across 17 standards such as ISSB, SASB, ISO 14064 for GHG reporting, ISO 14067 for product carbon footprint, and ISO 14068 for carbon neutrality, covering everything from ESG disclosure to GHG reporting to carbon neutrality to product carbon footprint. In summary, we work with all the standards listed on your screen, including assurance. This is our pride and passion. Where we do work for a think tank, the Climate Policy Lab. Um, as you may know, all consultants at Ecosustainability are not just standards users, but are standards contributors. We are well, there's global standard setters like ISSB, SASB, SBTI, Vera, GHG Protocol, and so forth. And there are standard users, for example, preparers who write reports, auditors, regulators, and corporations who follow the rules. Then there's a unique group of people who sits in between, like us, who provide technical commentary to help co-develop these standards. Today, you're learning from a group of people who have helped shape the standards. Just a few housekeeping notes. The session is being recorded for learning purposes, and please keep your microphones muted to ensure clear audio, but feel free to leave your videos on. You may post your questions in the chat box. Okay, all right. So, the greenhouse effect and global warming. Many have heard of the greenhouse effect, but don't actually know what it is. The greenhouse effect occurs when gases in the atmosphere retain heat close to Earth's surface, much like a protective blanket, keeping the planet warmer than it would be without them. Space is extremely cold, about negative 270 degrees Celsius. Without the natural greenhouse effect, Earth would be far below freezing, so we would all freeze and we will not survive. However, human emissions are strengthening that effect by adding greenhouse gases to the atmosphere. That extra warming is changing the planet's climate. Okay, our carbon accounting tracks the greenhouse gases linked to our activities. It follows a standard basket of 7 gases so we can measure, compare, and act effectively. The first is carbon dioxide. It is the most common greenhouse gas produced when we burn fossil fuels or clear land. Why it matters? It stays in the atmosphere for centuries and is the largest contributor to long-term warming. The second one is methane, a short-lived but powerful gas released from agriculture, including livestock, landfills, rice paddies, and fossil fuel leaks. It heats the planet 28 times faster than carbon dioxide over 100 years. Why it matters? Methane warms the planet many times faster than carbon dioxide in the near term, so reducing it delivers quick climate benefits. So we have to reduce our methane emissions. Nitrous oxide. What it is emitted from fertilized soils, manure, and some industrial activities. It has 265 times the warming potential of carbon dioxide. And yes, it is also the laughing gas at hospitals. Why it matters? It is far more potent than carbon dioxide per unit, so small emissions can have outsized climate effects. Hydrofluorocarbons, what they are. Synthetic gases used in refrigeration, air conditioning, and foam blowing, so we all use this. Why they matter? Some hydrofluorocarbons trap heat thousands of times more effectively than carbon dioxide, making leaks especially harmful. Perfluorocarbons, what they are, industrial gases released during processes like aluminum production and electronics manufacturing. Why they matter? They are highly persistent and very potent, remaining in the atmosphere for millennia. Sulfur hexafluoride, what it is, a highly effective insulating gas used in electrical equipment. It is one of the most powerful greenhouse gases ever discovered. It's actually 23,500 times stronger than carbon dioxide. So it matters because it is one of the most powerful greenhouse gases known. So even tiny releases can have large climate impacts. And the last would be nitrogen trifluoride. What it is a gas used in semiconductor and display manufacturing. It has a warming effect of 17,200 times stronger than carbon dioxide. Yes, your TV has a climate footprint even before you turn it on. Why it matters? Nitrogen trifluoride is extremely potent. As electronics production grows, its climate relevance increases. All these seven gases are being tested and measured for their potency over a 100-year period, and we call it the global warming potential, based on the Intergovernmental Panel on Climate Change IPCC assessment reports. The IPCC assessment report summarizes all the scientific knowledge about climate change, what's happening, why it's happening, what could happen next, and what we can do about it. All seven greenhouse gases are converted into carbon dioxide equivalent because each gas traps heat differently, as we have discussed. And carbon dioxide equivalent gives us one common unit to compare and combine them fairly so that we can calculate total emissions, track changes year to year, set targets, and report climate impact in a single, clear, comparable way. This is why every carbon reporting standard worldwide uses carbon dioxide equivalent as the universal measurement. Imagine you have 50 Malaysian ringgit and another guy has 30 Singaporean dollars and another guy has 100 US dollars. It'll be confusing. But if everyone converts US dollars, then we all understand the value. Carbon dioxide equivalent is the US dollar for seven gases. E stands for equivalent, meaning it's not carbon dioxide itself, it could be methane, but we convert it into carbon dioxide, which is the US dollar equivalent. Above pre-industrial levels describes how much warmer the Earth is today compared to the climate before large-scale oil, and gas use. Scientists commonly use 1850 to 1900 as the official pre-industrial baseline because it best represents the climate before widespread industrialization, mass fossil fuel burning, modern transport, and accelerated land use change. The Paris Agreement asks nations to limit warming to well below 2 degrees Celsius and to pursue efforts to keep it to 1.5 degrees Celsius above that baseline. As of today, sadly, we're about 1.4 degrees Celsius warmer. 2024 was the hottest year in record, and we have already experienced brief periods of overshoot. Temperature above 1.5 degrees Celsius, important warning signs, not a permanent crossing, because we consider multi-decades of temperature temperature rise. So why does 1.5 degrees Celsius matter? At 1.5 degrees Celsius, extreme heat and storms become more severe but remain more manageable with adaptation. Coral reefs and some crops suffer major losses, but global food systems and many communities can still adapt. Why 2 degrees Celsius is far worse. It's just half a degree warmer. A seemingly small increase, yes, but it brings disproportionately larger harms. Global economic losses rise several fold. Heat waves cut labor productivity, insurance systems break down in high risk areas, and food prices spike from crop failures because carbon dioxide um, Well, it lessens the nutrition of the crops. Ecological collapse accelerates, nearly all coral reefs will be lost, tropical forests and peatlands face dieback, and many species lose critical habitat. Social costs escalate. Over 1 billion people would face extreme heat regularly, as we're experiencing now. Mass displacement from coasts would intensify because low-lying coastal areas are prone to flooding and will be affected by sea level rise, and infectious disease risks would grow because of displacement not only of humans but also of animals. The moral question of overshoot. As we have mentioned, if warming temporarily exceeds 1.5 degrees Celsius and overshoot, priorities shift from preventing damage to coping with it. Wealthy countries can afford productive measures. Poor nations and vulnerable communities bear the worst health, economic, and social costs. The unequal burden is why the IPCC frames 1.5 degrees Celsius both a scientific and moral threshold. Bottom line, keeping warming to 1.5 degrees Celsius offers a substantially safer, fairer future. Still difficult, but far less damaging than 2 degrees Celsius, which would trigger systemic ecological, economic, and social crisis. Overshooting 1.5 degrees Celsius turns climate policy into crisis management with deeply unequal consequences. Okay, this chart shows the warming implications of different global emissions pathways through 2100. So the black line is the historical trend. Global greenhouse gas emissions have risen steadily to around 50 gigatons of carbon dioxide equivalent and have yet to show sustained decline. So it's rising even up to now. The pink line, 4.1 to 4.8 degrees Celsius, no climate policy scenario. In a world with no climate action, emissions continue to rise sharply, leading to extreme warming and severe climate impact. That's very warm. Orange line, the pathway for the current policies. Based on policies already in place, emissions plateau briefly before declining slowly. This trajectory is still consistent with about 2.5 to 2.9 degrees Celsius of warming, or roughly 2.7 degrees Celsius on current trends. The blue line, pledges and targets, if countries fully implement their announced commitments, including NDCs, net zero pledges, and methane reduction targets, as I mentioned a while ago, emissions would fall more steeply, limiting warming to around 2.1 degrees Celsius. This shows that ambition exists, but implementation remains insufficient. The purple and green lines, 2 degrees Celsius and 1.5 degrees Celsius pathways, science-based pathways aligned with the Paris Agreement require emissions to peak immediately, fall by about 50% by 2030, and reach net zero around 2050. These pathways demand much faster action than current policies and pledges. Okay. Our immediate collective task is to halt further global warming. 2 degrees of warming is the bare minimum for survival. This also gives us a much safer future but requires stronger action. The window is closing. Emissions must peak by 2025 or should have peaked by 2025 and drop roughly 42% by 2030 to stay below 1.5 degrees Celsius. COP28 marked the first global stack date under the Paris Agreement, revealing that progress across all areas of climate action remained too slow, and prompting countries to agree on steps to accelerate action, including a faster transition away from fossil fuels toward renewables. Our founder, Dr. Vincent Lim, was one of the speakers at COP28. All right. What is carbon accounting? Carbon accounting is a way for a company to measure how much greenhouse gas it emits from its activities, from using electricity to buying goods to transporting products. It turns all types of emissions into one common unit called the carbon dioxide equivalent. So the company can clearly see its total impact on the climate. By doing this, a company can understand where its emissions come from, find ways to reduce them, track improvement over time, and report the results clearly in its sustainability or climate report. To keep it simple, carbon accounting is like financial accounting, except it's for carbon. In simple terms, it tracks an organization's greenhouse gas emissions so it can understand its climate impact, reduce emissions effectively, and report transparently. We disclose greenhouse gas emissions based on GHG Protocol, or ISO 140641, which is a detailed guidance on how organizations should calculate their emissions across Scope 1, direct emissions, Scope 2, electricity use, and Scope 3, value chain activities. GHG Protocol and ISO 140641 standardizes definitions, boundaries, and methods so that companies everywhere measure emissions the same way, making results consistent, comparable, and credible. GHG Protocol is the foundation used by the Science Based Targets Initiative, Carbon Disclosure Project, many regulators, and most companies globally for carbon accounting. So just remember the three Bs. Scope 1, energy that you burn yourself. Scope 2, energy that you buy from someone else, the electricity company. Scope 3, everything that is beyond Scope 1 and 2, everything in the supply chain. On September 9, 2025, the International Organization for Standardization, or ISO, and GHG Protocol announced a strategic partnership to harmonize and co-develop their greenhouse gas standards. The aim is to produce a common global language for emissions accounting. But they took a step further this year by announcing on July 29, 2026, just last week, GHG Protocol announced that they and ISO are to combine their corporate carbon accounting standards into one global standard with a public consultation on the future corporate standard plan for the second quarter of 2027. The consolidation brings together GHG Protocol Scopes 1, 2, and 3 and actions and market instrument standards with ISO 140641, creating a more integrated and efficient framework for businesses and other users while enabling more meaningful stakeholder participation through a single, coordinated public consultation process. Beyond the technical synergies, unifying the two most widely used carbon accounting standards is expected to help mobilize greater investment and accelerate global decarbonization. The existing ISO 140641 and GHG Protocol standards continue to be valid and may be used while the consolidation is underway. There is no requirement to discontinue their use at this stage. The core principles of robust greenhouse gas accounting, accuracy, completeness, consistency, and transparency remain fundamental and continue to underpin all guidance. So the first step to carbon accounting is defining the organizational boundary. Organizational boundaries simply mean deciding which parts of your company to include when calculating your carbon emissions. It answers the question which entities, sites, offices, teams, or subsidiaries belong inside the carbon footprint and which do not. You choose these boundaries using clear rules. There are rules, of course, such as whether you own control or share control over an operation so that the carbon accounting is consistent, fair, and reflects the real structure of the business. So it must reflect the actual reality of the business operations. First would be operational control. You choose this when you run the show. Use operational control if your company manages the day-to-day operations, even if you don't own 100% of the business. You choose this when you decide how the site is operated. You control operational policies, safety, energy use, maintenance procedures. You influence emissions directly through daily decisions. For example, a warehouse is 40% owned by you, but you operate it fully. You choose operational control. Most companies use this, especially multinationals. Financial control. You choose this when you control the money. Use financial control if your company makes the financial decisions for the business. You choose this when you approve budgets. You control financial risks and rewards. You make investment decisions. You consolidate it in your financial accounts. For example, you own 51% of a joint venture and control financial decisions. Choose financial control even if you don't run daily operations. This approach aligns closely with accounting consolidation. And the third one is equity share. Choose this when ownership percentage matters. Use equity share if you want to report emissions based on how much of the business you own, no matter who controls operations. You choose this when you have multiple joint ventures. You want your emissions to match your ownership stake. The business structure is complex. You need a fair split for investors or partners. For example, you own 25% of an overseas plant. You report 25% of its emissions, even if you don't control anything. This method is common for investors and conglomerates. Step two would be to categorize the sources of emissions. Scope one, direct emissions from sources the company owns or controls, company facilities, company vehicles. Scope two, indirect energy emissions from purchased energy used by the company, purchased electricity, purchased heating, cooling, and steam. Scope three, other indirect emissions, all other value chain emissions not included in scope two, beyond scope one and two. Okay. The GHG Protocol's corporate value chain scope 3 standard divides indirect value chain emissions into 15 distinct categories split into upstream and downstream activities. Upstream categories cover indirect emissions from a company's supply chain and inputs leading up to operations. On the other hand, downstream categories cover indirect emissions resulting from the use of products after they leave a company's ownership or control. These are examples of different sources of emissions. Based on the documents and information our company provides, we identify the source and categorize your emission sources across key operational areas. This includes company structure, ownership and control relationships, as we have discussed, operational locations, offices, buildings, warehouses, factories, utility and fuel use, electricity, diesel, petrol, gas, procurement and spend data, what your organization buys, movement of goods, logistics and distribution, movement of people, business travel and employee commuting, waste and water data, supplier-related information, digital and IT footprint, outsourced and third-party activities. Step three would be to quantify your greenhouse gas emissions. For every emission source identified, you must also define what kind of data it uses, where the data comes from, how reliable the data is, whether it needs to be estimated, and how often it will be collected. This ensures accuracy, consistency, and auditability. Types of data used for carbon quantification. When calculating emissions, four main types of data are required. The first would be activity-based data. This is the physical quantity of the activity causing emissions. Examples are mass, kilograms of waste, volume, liters of petrol, energy use, kilowatt hour of electricity, fuel properties, calorific values, fuel composition, distance, kilometers traveled. This method is the most accurate because it relies on actual physical quantities. Second would be spend-based data. This uses money spent as a proxy when physical activity data is not available. Examples are amount spent on courier services, amount spent on IT services, amount spent on cloud hosting, amount spent on advertising or professional services. These are useful for scope 3 categories where physical data is almost impossible to obtain. The third one would be emission factors. An emission factor converts activity data into emissions. It is usually expressed as tons of carbon dioxide equivalent per unit of activity. For example, tons of carbon dioxide equivalent per kilowatt hour, tons of carbon dioxide equivalent per liter, tons of carbon dioxide equivalent per currency spent. Examples are country grid electricity emission factor, diesel combustion factor, air freight emission factor, waste to landfill factor. Emission factors must be from credible sources, IPCC, government datasets, verified databases. The fourth one is global warming potential. Global warming potential tells you how potent each greenhouse gas is compared to carbon dioxide. Global warming potential translates the impact of different greenhouse gases into a single comparable figure expressed as carbon dioxide equivalent. Okay, when selecting emission factors, there's a criteria. They must be from a trusted source, relevant to the activity, updated for the year being measured, capable of producing accurate, repeatable results, consistent with previous reporting methods. Examples of emission factor databases, IPCC emission factor database, US EPA, DEFRA, and Singapore Emissions Factor Registry. The three main uses of data tiers or different data tiers. First, to assess the reliability of emissions calculations, Tier 1 reflects rough estimates, Tier 2 indicates moderate accuracy, and Tier 3 represents the highest level of precision. This helps show whether results are approximate or close to actual emissions. Number two, to guide data quality improvements over time. Data tiers indicate your current position and the next step for improvement. The usual progression is from tier 1 to tier 2, and then to tier 3 as better data becomes available. The third would be to support reporting and verification requirements. Different frameworks and assurance processes expect different levels of data quality. Higher tier data is generally more defensible for audits, target setting, and carbon credit or sustainability reporting. For scope 3, tier 1 typically relies on global averages, spend-based factors, or generic databases. So it's useful for screening but comes with higher uncertainty. As you can see the figure here. Tier 2 uses country-specific or national averages, which are more relevant but still do not reflect individual supplier practices. Tier 3 uses supplier-specific activity-based or measured data, making it the most accurate or audit-ready option. In summary, data tiers help assess emissions data quality, track improvement over time, and support reporting and assurance by showing whether calculations are based on broad averages, country-level factors, or supplier-specific activity data. Let's explore global warming potential in a simple way. Imagine the Earth is inside a room, and greenhouse gases are like blankets around that room. Some blankets are thin, like linen, so they only keep a little bit of heat. Others are very thick, like wool or down, so they trap much more heat. Global warming potential is a score that tells us how thick each gas blanket is compared to carbon dioxide. When we multiply emissions by the global warming potential, we convert everything to the same unit, carbon dioxide equivalent, so we can compare different gases fairly and consistently. Think of greenhouse gases as different kinds of blankets around the Earth. Carbon dioxide is like a standard blanket, so we use it as our main point of comparison. Some gases, like methane, act like thicker blankets, while others behave like very heavy winter blankets that trap much more heat. Global warming potential tells us how powerful each gas is at trapping heat compared to carbon dioxide. On this slide, uh, we first calculate the tons of each gas emitted. So activity data times emission factor equals tons of emissions. Then multiply it by its global warming potential. This gives us emissions in carbon dioxide equivalent, which means if this gas were carbon dioxide, how much carbon dioxide would it be equivalent to? Using carbon dioxide equivalent lets us express all greenhouse gases in a single comparable number. The fourth step would be preparing the report. Even when greenhouse gas inventory is used only internally, the organization should still prepare a formal greenhouse gas report. A well-structured report organizes data in a clear and consistent way, makes the inventory easier to audit or review, helps management understand the impact of decisions on targets, reduction plans, and budgets, builds readiness for future external reporting, facilitates internal or external verification at a later stage. The report should be aligned with the purpose and intended use of the inventory. Examples of internal purposes uses. Supporting internal decision making, such as setting emission reduction targets, reporting through group or regional headquarters, submitting data to an internal sustainability or ESG committee, participating in voluntary initiatives such as the Carbon Disclosure Project. Even if the report is not intended for public disclosure, it should still follow an appropriate structure so that it can be verified if needed in the future. If the organization intends to engage an independent verifier to review the greenhouse gas inventory or make a public claim that the inventory conforms to ISO 140641, then a formal greenhouse gas report is mandatory, not optional. The verifier relies on the report because it sets out in a transparent manner organizational and operational boundaries, data sources and data collection approaches, key assumptions and estimation methods, emission factors and calculation methodologies, treatment of uncertainties, final emission totals, and any material exclusions. Without a robust greenhouse gas report, the verifier cannot determine whether the inventory conforms to ISO 14064 or not. If third-party verification is completed, the verifier will issue a verification statement. This typically includes the scope of what was verified, the level of assurance, whether it's limited or reasonable, the standards applied, for example, ISO 1406443, the verification opinion, is it fairly stated in all material respects or not? Any limitations, findings, or recommendations. The organization should make this verification statement available to relevant intended users such as senior management and the board, regulators and oversight bodies, customers and supply chain partners, investors and lenders, the public where the statement supports a sustainability or ESG report. Doing so enhances transparency, supports stakeholder confidence, and strengthens trust in the organization's climate and sustainability disclosures. To maintain high-quality disclosures, report preparers should follow these principles. First, provide comparative information. Present current year carbon metrics alongside at least one prior year or the most recent available year, except in a first-time report. Why? Comparative information helps stakeholders see performance trends, assess whether emissions are increasing or decreasing, and judge whether reduction targets are credible. Second principle, correct prior period errors. If you identify a mistake in your previous year's carbon accounting, for example, wrong emission factor, incorrect activity data, missing supplier data, you must correct the error. State the affected year and briefly explain the correction. Why? Transparent correction of errors strengthens confidence in the report and supports trust in the organization's disclosures. Third would be to minimize duplication. Avoid repeating the same numbers, charts, or explanations in multiple sections of the report. Why? Duplication can confuse readers and increases the risk of inconsistent figures and messages. Fourth would be use cross-references to other reports when appropriate. You may refer to another report, for example, annual reports, sustainability reports, climate disclosure project responses, instead of repeating data, provided that the reference content is readily accessible, the other report is published at the same time or earlier, the reference is precise, page and or section. The information is consistent across reports. For example, in line with IFRS S2, physical risk exposure for Philippine operations is disclosed in the annual report, page 62. Why? Appropriate cross-referencing reduces duplication and supports consistency across disclosures. Fifth, disclose information that is material and connected. Focus on information that meaningfully affects stakeholders' understanding of the organization's climate impacts, risks, and opportunities. This is for the principle of principle of being material. Okay, for the principle of being connected, carbon disclosure should be integrated into the broader narrative of strategy, business model, risks, governance, financial impacts, targets, and transition plans. They should not appear as standalone numbers. For example, if Scope 3 emissions represent 90% of total emissions, the report should explain how this links to supply chain strategy, procurement decisions, supplier engagement, and future climate targets, because 90% is material. Why? This ensures the report is more than a greenhouse gas table and provides a coherent, decision-useful climate story. Sixth principle, aggregate or disaggregate data appropriately. Decide when to show totals and when to break information into more detail. Aggregation is appropriate when totals convey the message clearly. Individual categories are not material on their own, and combining data does not obscure key risks. Disaggregation is required when a category is material, stakeholders need more transparency, decisions rely on granular data, or emissions differ significantly across regions, operations, or suppliers. For example, disaggregate Scope 3 Category 1 purchased goods and services if a single supplier accounts for 45% of total emissions. Disaggregate Scope 1 by the 7 greenhouse gases, so we have to disaggregate Scope 1 by the 7 greenhouse gases. Scope 2 may be shown in aggregate where appropriate. Why? Appropriate aggregation and disaggregation help stakeholders understand where emissions and climate risks are concentrated and how they are being managed. This is up to the company to decide which they think is material and which they think are relevant. Under ISSB IFRS S2 climate-related disclosures, reporting of greenhouse gas emissions is a required component of climate-related information, so we make use of GHG Protocol. The objective of climate-related financial disclosures and risk management is to enable users of general-purpose financial reports to understand an entity's performance in managing climate-related risks and seizing related opportunities. So it's not just risks, but also taking advantage of opportunities, including progress towards climate-related targets it has set for itself and those it is required to meet under applicable laws and regulations. So just remember BSCR or BSQR. B for boundaries, organizational boundaries. S for source, where is the emission? C or Q for calculate or quantify. R for report. Thank you. If you have any questions, we will be happy to answer them. Are there any questions in the chat box? Mm, right. Anyone? Uh, if you don't have any questions, uh, you can share any insights that we can learn from or any interesting experience your company has. Yes. Katja. Yes, please.
Hello, everybody. I'm Khadija Aslam. So basically, there is this one thing that I just wanted to add, and that is I'm a sustainability and ESG consultant myself. And what happened in my company when I used to work in one of the most renowned sapphire textile was that sustainability was one of our major motive over there, but due to lack of knowledge and people around us, they are not able to accept that fact that sustainability is a more needed thing. They are unable to pursue it. So my question is like, how do you start with this factor? How do you make people to adapt this sustainability factor? So this is one of the most uprising question in my head.
Okay, well, sustainability reporting is quite new for everyone. So you just have to start collecting data, having everyone on board. So it doesn't have to be perfect all at once. You don't have to produce a 100-page report on day one. You just have to start collecting data and having everyone on board because it's a team effort as well. I hope I have answered your question.
Thank you so much. Thank you so much.
Oh, thank you for your question. Anyone else? Boundary setting. Oh, sorry, that's key. Sorry. Mm, Um, it doesn't have to be a question. It could be, like I said, an interesting experience your company had or has. Any insights we can learn from you? Anyone? We still have time. Anyone? All right. Okay. Um, okay. We run free. Oh, sorry. Mm, okay. We run free talks every Monday, either at 11 a.m. or at 8:30 p.m. Singapore time, covering a wide range of sustainability topics. And they're open to everyone. For more details on upcoming sessions, please check out our website at ecosustainability.group/events. And if you haven't, uh, sorry. Okay, please join our LinkedIn and WhatsApp community for the latest updates and scan the codes. Ah, okay, let's stay in touch. We'd love to see you again at our next session. My colleague Shireen Rat will discuss the Thai regulation. Also, if you have any inquiries, please contact them, Henry, Ariel, CD, and Shireen Rat. They'll be happy to help. He Harry, yes. Yes, Harry. Go ahead.
Okay. Thanks. Please reshare the QR codes for the WhatsApp so
Okay,
that we can join.
okay, there you go.
Okay. Why is it not connecting? All right. Thank you.
You're welcome. Mhm. So here are the contact details of Teng, Henry, Ariel, CD, and Shireen Rat. And once again, thank you and have a good rest of your evening or day for those in other time zones. Thank you.